points, right? So US interest rate has been very stable for the past, I would say, 1.5 years. Now, there is a very clear expectation that rates will go higher. Why are they going to go higher? Well, it's because two reasons, right? One, the inflation has kind of picked up in the past few years, a few months. So the US CPI, the CPI inflation has come off, had come off up to last December, Jan, right, to closer towards 3% and below. But then now it has spiked higher after the war because of the crude prices and so on. So this is something which the US Fed does not like, right? The US CPI has been really, really a problem, but around 3.5%, the headline number, which is still on the higher side, right? So rate hikes are the base case expectation right now. No, second reason is, of course, the GDP growth has been fairly good. Despite the war, despite everything, the whole AI boom has created enough GDP momentum that Fed is not worried about hiking rates. So the combination of these two, right, potentially higher good GDP growth and higher inflation is causing expectations of higher rates in the future, right? So all this retail sales, I mean, all this macro data is pointing to reasonable reasonable economy. Even jobless claims is showing a good employment thing. Unemployment rate is very, very stable, right? So all these are pointing to fairly stable economy. Of course, month on month, the jobs data is showing slight weakness, but still, there is not enough for the Fed to get worried. So you are seeing a good, healthy economy with potentially higher inflation. Now, this has an implication for the dollar interest rates, right? Now, I mean, again, all the data points I'm showing, just running through ISM. I mean, every data point is fairly stable, right? Not manufacturing PMIs, right? Everything is stable. Now, because of this inflation, what has happened is, if you look at the in the past few months, right, this data point, this whole area, right? In the past few months, there's a sudden spike in US yields. Now, this is an important thing for rupee because when US rates go up, rupee becomes weaker or dollar becomes stronger, right? So this sharp rise in the yields in the past few months, right, especially the last leg, the whatever initial when the Iran war happened and so on, whatever that initial thing had happened here, it came down, right? But then again, it's going up, right, because of the inflation concerns. So this is a problem for rupee. Higher yields means the rupee cannot appreciate much. It has to sort of stabilize. It's very difficult for rupee to appreciate a lot when US interest rates are going higher. So this is the fundamental issue when it comes to rupee, right? And even markets are pricing in the same thing, right? They're actually pricing in. If you look at the current rates, it's 3.83, but they're now pricing in higher rates, at least roughly 2 to 3 hikes in the coming uh, uh, few months. It's not significantly high, but they're pricing in. Right? More importantly, the long-term rates, 10-year US yield is high. That is a problem for the rupee. Now, as a result, you notice dollar, which was very sort of weak before the Iran war and so on. After the Iran war got settled in the past 2 3 months ago, when there was ceasefire and all, now has shot up again. Why? Because US yields are going higher, which means dollar is stronger, right? And that is one of the issues with rupee. Now, so basically, this number, core PCE, the inflation, again, it's also picking up higher, right? So net, what we want to basically say is higher interest rates are the base case expectation driving the US dollar. This is the US picture. Now, even the Fed, the so-called no, the Federal Reserve, which actually does the interest rates, right? Even they are projecting almost roughly one, at least a hike, if not more, right? These are all their expectations in the coming few months. So they are all expecting some sort of a hike. So this is a problem for the emerging markets like rupee, right? So this is where we are on the US side. Now, this is one of the reasons why rupee is refusing to appreciate a lot. If you look at the rupee behavior, we'll discuss the domestic aspect a bit. But if you look at the rupee behavior, right, once see it went into an all-time high, right? This was the time when 100 was being discussed, right? In the last April May period, massive outflow. Sorry, May June period, right? Massive outflows, FII selling. Everybody was talking about panic, rupee going towards 100. That was a period. But then after a point, this the global ceasefire happened. Iran war, Iran US agreed to a ceasefire. At least the bombing stopped, and the Strait of Hormuz was supposed. At least the hopes of a proper opening up. All those ignited massive correction in the oil from 110 or from to 80. Right. So coinciding with it, RBI was also came up has come up with this FCNR hedge cost waiver, the ECB cost hedge cost waiver for PSUs, right? All of the schemes to attract dollar flows. So all of this put together, rupee went towards 94.33. But there were a lot of expectations that rupee will now go towards 93, 92. A lot of noise in the market around 91. It can go anywhere. That kind of conversation. But then rupee has again come back to 96.26, right? Now it has come off to 95.60. But the point is, it's again trending up. Why? Right? One of the reasons is US yield, which I discussed. Dollar strength, US long-term yields being higher. It structurally prevents, right? It's very rare that rupee actually appreciates when yields are going higher, right? So that's one factor. And the second factor, of course, is the genuine structural problem for the rupee.